Tax increases may not be coming as quickly as we all thought. I'll give you an update on that, but still, they're inevitable, in my opinion. So how do you prepare for higher taxes? I've got 3 ideas coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Corhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. So back in April, you guys all know the White House proposed an infrastructure spending bill that had a price tag around $2.3 trillion and all sorts of proposals. But embedded within the proposal were some meaningful and yet sort of obvious tax increases. I say obvious because it's been what the president has been talking about on the campaign trail for a while. And so within the bill, again, with that massive price tag, there were some proposed tax increases, okay? Now, one of those was increasing the top tax bracket from 37% to 39.6%. Not an enormous increase, but an increase nonetheless. Second was an increase in the corporate tax rate, moving it back from 21% up to 28%. That'd be a significant change, right? And then the third major tax increase proposed within the stimulus or the infrastructure stimulus spending plan, whatever they're calling it, was an increase in the capital gains rate for those individuals that have income greater than $1 million. And you might say, well, gosh, they can afford to pay more in taxes. I'm not going to argue with that. I would just tell you that, oftentimes if you're selling a significant, a small business or selling something that has appreciated significantly, that can all of a sudden mean you go from a normal tax rate or tax bracket of 22 or 24%, all of a sudden catapulted up and show very high income for a small period of time. Anyway, so those were the 3 major tax increases. And listen, latest on Capitol Hill is that they're trying to amend the bill to move forward with many parts of the infrastructure spending bill, but without any of those tax increases. Apparently, lawmakers have had a hard time digesting those tax increases along with the proposed spending, the proposed infrastructure. And so, this could change by the hour, but the latest I've heard is they've just dropped it. They've dropped those tax increases. So does that mean you're safe? Don't worry about it. No, just go ahead and look at, number one, the White House budget that came out. Those tax increases were baked into the budget, baked into the assumption, baked into the plan for spending. So, okay. Second, look at our national debt. I think it's going up. Right? And tax revenue obviously is what goes to pay that and combat that versus more borrowing, i.e. a Ponzi scheme. Okay. And then third, just look at historical tax rates. Just that quick look would tell you, what? Still seems like taxes are probably going to be on the rise. Whether it gets back included in the infrastructure bill, whether it gets tagged on in the families plan as they discuss that, or whether there's a future proposal, I don't know. But I think it still is prudent to be planning for taxes and be planning that they could be going up in the future. So if that's the case, what do you do about it? I have 3 simple yet the most powerful ways to prepare for higher taxes. I've got that right now. Number 1, the obvious one is if you think taxes are low today and could be going up in the future, or think your tax bracket is low today and could be higher in the future, as you're saving up for your future, use the Roth IRA or the Roth 401k. All right, that one's obvious, but again, the Roth sort of is a buzzword these days, so let me just tell you how that works. As you contribute into the Roth IRA or your Roth 401k, the contributions you make are not a tax benefit. You get no deduction, you get no tax benefit on those contributions. However, those contributions are added to the account and then you buy investments, and when you buy and sell, or when those investments have dividends or any sort of distribution, you're not taxed on any of that. It all stays within the account. It's tax sheltered, okay? So the activity of the account doesn't show up on your tax return every year, and that growth is all then tax deferred. Well, if you've held a Roth IRA for 5 years and are age 59 and a half, when you withdraw the dollars, that's a qualified withdrawal, and all of that growth is withdrawn tax-free. What about the money you've contributed to it? Well, you never deducted it in the first place, so when you draw that money back out, it's not taxable either. So it's a way of basically saying, well, I'm in a low tax bracket today, so I don't need the tax deduction. Let me invest some money into a Roth. All that activity is sheltered on its way up over all these years and years, and then when you withdraw the dollars in the future, again, presuming higher taxes, it's tax-free at that time. So Roth IRA, if you are below the income limits and are eligible to contribute, a Roth 401k if you're above those income limits and you work at an employer that offers a 401k that has a Roth provision with it, the obvious retirement vehicle, if you believe tax rates are low today and going higher in the future, is the Roth IRA, the Roth 401k. Next, you've got to consider the HSA. If you think taxes maybe are going up in the future, okay, it really doesn't matter with the HSA what you think taxes are right now, whether they're high, low, or whatever, but if you think they're going up in the future, wow, an HSA, health savings account, could be an enormous financial tool for you. And so number one, you need to have a qualifying high deductible health plan. Now, notice and recognize that the word high is a relative term, right? And so, you know, for one person, that seems like it's a high deductible. For someone else, that seems like a low deductible. I don't know. So you have to have a qualifying high deductible health plan. You will know. It'll say HSA eligible, something like that, okay? If you have a qualifying high deductible health plan, you are then able to open and fund a health savings account. You don't have to, but you're able to, okay? You can open that health savings account wherever. If you're going to put the money in and then quickly spend it towards your deductibles, towards your medical expenses, then, you know, just have it at the bank or the credit union. Make sure it's free. Make sure it's, you know, cheap and convenient, okay? If you're not going to quickly spend it and you're going to save this money up but pay out of pocket for your medical expenses and let your HSA grow, then I'd invest it, okay? You can invest it, you know, at Fidelity or other places in whatever strategy you so choose. But here's how the HSA works. When you contribute money into your HSA, it's a tax deduction, okay, up to a certain limit, whether it's an individual plan or family plan, whether you're age 55 or older or not, okay? So you get a deduction on your contribution into the HSA. And then any interest that pays, or if you invest it, any activity, that's all sheltered from taxes. And then when you withdraw the money from your HSA towards a qualifying medical expense, and that could be, you know, getting glasses, paying your deductible, doing a copay, buying prescriptions. There's a whole host of things, all right, that you can use this HSA money for. When you withdraw the money from your HSA to either cover or reimburse yourself for one of those expenses, tax-free, comes out tax-free. So this is like the Roth IRA, that there's no tax consequence when you take it out, but it's really the best of both worlds because you get a deduction on the way in and no tax on the way out. The HSA traditionally, for the past 20 years, has been thought of as a health savings account, mostly like a health spending account. You put the money in, and then when you have health expenses, you spend the money out of there. And now, like the lights are coming on to this amazing tax opportunity where you can actually use it as a savings account, like a retirement savings account, meaning you contribute the money when you have a qualifying high deductible health plan and it avoids taxes. It's a tax deduction, but then leave the money in there as long as possible. Leave it in there as long as possible, as long as that fits within your financial life, because it's growing tax deferred and you can withdraw the money tax free. So don't be in a hurry to withdraw those dollars. But again, going back to the point of the video, if you believe that taxes are going to be higher and going up in the future, use the HSA. If you're eligible, use that HSA. Don't be in a hurry to withdraw those dollars. And then the third idea, if you believe tax rates are going to be higher in the future and you yourself are going back to college, you want to help your kids with college, you want to help your grandkids with college, the 529 plan, 529 college or education savings plan is the right tool for you. This is essentially the Roth IRA, but for college, okay? So the 529 plan, your contributions that go into it, it's not tax deductible, okay? You don't get a federal tax benefit. If you live in a state that has state taxes and they offer a state tax incentive on your contribution, maybe you get a tax credit like you do in Indiana, maybe you get a tax deduction like you do in Michigan, or maybe you get nothing at all. On the federal level, the contribution, it's not tax deductible. So you're not, for most people, unless there's a state incentive, like I said, you're contributing to the 529 plan not to get a current benefit. But then those dollars are invested, hopefully prudently, for your child, for your grandchild, for yourself. And all that investment activity is all sheltered, so it doesn't land on your tax return. And then if you withdraw the money for a qualifying educational expense, tuition, room and board, a required expense like lab fees or computer or application fee, that sort of stuff, then you withdraw that money tax-free. That growth comes out tax-free, and your contribution never was a deduction anyway, so you withdraw that tax-free as well. So it's just like the Roth IRA. Money in where it doesn't give you a deduction, but tax-free when it comes out. Is that the full exhaustive list? No. Sit down with your certified financial planner, explore all of the tax shelters available to you, all of them. That's their job. Their job is to bring you clarity, confidence, and creativity. Hey, based on your situation, here are all the tax shelters available to you. And then by looking at all 6 areas of your financial life, how those 6 areas fit together, they can help tell you, okay, of all of these tax shelters, this one doesn't make sense, this one doesn't make sense, but this one, that one do make sense. And when you prioritize your financial goals, you should be attacking and max funding these 2. This makes the most sense. All of that within the context of your current tax picture, tax planning, to see if you're likely in a low tax bracket today and tax rates could be higher in the future. Or just simply tell your CFP, hey, I want to hedge against tax rates going up in the future. What are we doing right now to make sure we're protecting against that? Or what could we be doing differently to protect against that? That's the job of your CFP. It should be collaborative discussion, and they're giving you confidence, clarity, confidence, and creativity. All right. If you don't have a CFP on your team or they're not offering that, you can contact one on my team. Find us online, corehorn.com. That's Corehorn with a K. wisemoneyshow.com. You can find us there as well, or just give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.